Hello, everyone, and welcome to Currency Exchange, a NatWest podcast all about foreign exchange markets. I'm Brian Daingerfield, co-head of G10 FX Strategy at NatWest. I'll be your host today. Welcome back, everyone. Happy 2026. A big year ahead, and certainly a very exciting start to the year in foreign exchange markets. And sort of preview 2026, think about some of the drivers at the beginning of the year and talk about some of the events that have already happened to start the year. I'm very happy to be joined, as usual, by Paul Robson, who co-heads G10 FX Strategy with me, sitting over in London. Paul, thanks so much for joining.
Well, thanks as ever for the invite to be on the podcast. At this point, I still feel like I'm more like 50% Stilton cheese than anything else. So I'm still working through excesses over Christmas, but looking forward to delving into major currency markets in this week's Currency Exchange podcast.
Yeah, so where I want to start is actually in the UK because over the holiday, we've all sort of been maybe you were on vacation, maybe you were not as tuned in, paying attention as closely to markets, but quietly sterling has had quite a little run here, reaching at points 4 months highs versus both the dollar and the euro. Paul, what do you make of this move, and what are some of the drivers you think behind it?
Yeah, like you say, sterling sometimes feels like watching a kettle boil. If you watch it, it doesn't. You move away for a couple of weeks and then you realise that it's actually moved quite a long way. And like you say, it's had a good run over the last few months. It started to recover back in November. Sterling actually had a difficult time for much of 2025, whether it's sort of stagflation fears or fiscal policy fears. It started off the year quite well, but once growth expectations started to soften a little bit, the currency also weakened. So it started to recover at the end of last year and carried on through into December. The currency tends to be seasonally strong in December, and I think some people took their eye off the ball a little bit because in recent years there's been other drivers of sterling and currency markets just generally at the end of the year, and it loosens the seasonal correlation. But certainly over the last sort of 15 years, there does seem to be support, whether that's something to do with tax payments that are due in January, sort of got this quarterly pattern in the currency. But the outperformance of sterling, not that it's significant, it was just a snap of trend that was persistent in the second half of last year, has been correlated with narrowing government bond spreads. So at the same time as the currency has done a little bit better, so have gilts, for example. So the gilt bund 10-year spread is now back at the narrowest levels that it's been since sort of late 23. So there does feel like there's a fiscal policy driver at play here. Regular listeners might recall that we talked about November's budget in quite a lot of detail, that it was actually, in the end, a reassuringly boring budget. There was lots of worries about the budget, but in the end, there was no major misstep. There was no major surprises. Surprises are really good at Christmas, but they're not so good when it comes to fiscal events and budgets in the UK, and there weren't that many there. You might recall also that the tax increases that were announced were all sort of backdated. Now, that might lead some people to worry about whether the forecasts are that credible, but it does mean that you're not going to get near-term big tax increases that weighs on growth, that needs to see a central bank policy response. And again, that plays into the currency. And then also that fiscal event, I think maybe markets thought that political risks, leadership change risks were sort of put on the back burner for a little bit. The budget was greeted well by MPs, Labour MPs, Parliamentary Labour Party backbenchers. And again, that might ultimately become an issue at some point, but short term. So you had this, I think, reduced fiscal risk premium in the currency, and those last year, those were like I said earlier, the two major risks were this stagflation risk, fiscal risks, and both of those had been sort of reduced through that budget. I don't think there's a lot of room for the currency to continue to outperform. I think the currency had been oversold. I think that there was widespread pessimism around the UK economy, fiscal policy, and the currency for next year, and I think last year. And I think that has unwound a little bit. Looking ahead, I think the risks do build a little bit once we get into the sort of spring statement period in March. And then beyond that, we've got May local elections here in the UK, when again, maybe people might try to romance the idea of sort of political risk. But from here now, I think focus very much on monthly government borrowing numbers to see whether those new projections are credible from the OBR. If we started to see overshoots in borrowing, I think that would weigh on the currency. And I think also just watching the growth indicators with an economy or a country that has twin deficits, both fiscal deficit and a current account deficit. One of the things for the UK is how does the UK pay its bills, for example? And one way you pay that is offering good returns, strong growth, and a high yield. And so that's going to be important for the outlook for this year, I think.
Yeah, super well said. And I feel like I should give you your flowers here because, one of the things we've been talking about a lot on these podcasts, certainly leading into the budget and after, was this idea of UK pessimism maybe being overpriced in the currency. I know that was one of your big themes, and having seen that play out, I think that's worth highlighting here. That's that does feel like what we have seen. I want to transition into Euro here. What are you watching in Euro early in 2026, and how are you feeling about the common currency here?
Yeah, so it's all been relatively quiet for the euro, and I think that's going to be generally the theme for this year in general. But the sort of lack of drama around the euro area, I think that's going to be important. And my focus is going to be squarely on how the euro performs against the dollar. I think if that's very worth paying more attention, because if that starts to move, they're the two sort of, I've always said this in the past, and I think we've talked about it. Two main currency anchors for global currency markets, one being dollar CNH and the other one being in euro dollar. And the euro just has a bit of an anti-dollar feel to it. And I was always struck by, I mean, I very rarely talk about physics and Newton's third law, but that states that every action has an equal and opposite reaction and force. And you feel as there's more drama around the US, maybe the opposite force of that is maybe the euro benefiting. And I think also euro dollar fits very squarely with the whole their strategy team here at NatWest sort of year ahead themes. Again, regular listeners might recall we've got these 6 themes. We've got monetary policy, divergence, fiscal policy. We've got your excellent Trump 2.2 piece in the year ahead, geopolitics, and sort of trade flows as well. And I think that they play very much into the sort of dollar view that I'm very keen to ask you about in a couple of minutes' time. But the opposite of that, who are the winners from any sort of loss in the dollar? And I think it's the euro. So I think just watching how this evolve, and certainly the weekend events were certainly dramatic. And again, just place that idea of being sort of less drama, maybe anti-dollar favours the euro, and so euro dollar higher. I think through the year is what I would expect at this point at least.
Yeah, I certainly agree with that from the dollar side. But before we turn to the weekend events and back to the U.S., I do want to ask you. It is the new year now, new 2026. New Year's resolutions very much in vogue right now. Any big New Year's resolutions you think for FX watching that markets should be keeping an eye out for here?
Yeah, I think, new year, new resolution. I mean, my main resolution is to eat less Stilton through the year. But for when it comes to currency markets, then I think just watching the dollar. I mean, again, I always listen very carefully to what you say on the dollar. I'll be listening extra carefully. I think that's going to be a good friend, I think, for watching currency markets in 2026. For Europe and the euro, I think very much watching the German economy. If that, to what extent that turns around, fiscal policy, I think that's definitely going to be a focus. Here in the UK, as I say, I think it's going to be fiscal policy and growth. So, and then just watching capital flows and how they're shifting in this new world order and policy divergence, fiscal policy, geopolitics. If the money isn't going to the US at the same pace, or maybe it does, or is it flowing out? Where does it go? And that's definitely my sort of New Year's resolution in terms of policy. But in terms of those geopolitical events, I mean, no rest for the wicked, is there? Sort of early in the new year, we had the events of the weekend. I'm just thinking, how are you thinking about those geopolitical events and how they might move the dollar over the short term?
Yeah, so I think it's super interesting just to dovetail on how you sort of talked about the dollar and how the dollar's relationship with some of its traditional drivers might be shifting, weakening, strengthening in some cases. If we were doing recording this pod 5 years ago, I think it's not unreasonable to think that the dollar would be a lot stronger versus everything global currencies. In light of this weekend's events in Venezuela and the capture of Maduro and the potential uncertainty, the spillovers into energy prices, into the region, and just a broad pickup in geopolitical tensions, right? That the dollar status as an unquestioned safe haven would leave the dollar as by far the best performer in this kind of environment, maybe matched with, by yen and Swiss more recently, more so than the yen, considering the yen has really struggled as a kind of proxy safe haven more recently. But now we've seen maybe a different picture for the dollar, which is that dollar has strengthened to start 2026. But it hasn't been entirely, it hasn't been at universal strength. And if anything, you see some currencies in region in Latin America have actually strengthened against the dollar despite this event in Venezuela. And so as you look across, you see maybe a surprising group of, call it, early winners and losers as we look across FX. And so, I think that there's a broader read through from how the FX markets are thinking about these events, that volatility is still relatively low. We came into the end of the year with low levels of market volatility in foreign exchange. Volatility has not picked up meaningfully in light of this, in light of the events in Venezuela. The FX reaction hasn't been uniformly in a sort of risk off pro dollar sort of direction. I think that speaks to the way the market is taking this as sort of a potentially isolated incident, one that does not necessarily lead to contagion outside of region. Certainly, this idea of lack of contagion from geopolitical risks is something that we were thinking was maybe going to be a feature for 2026. So far, that looks to be the case. And for the dollar, I think, as I mentioned, the dollar has strengthened a little bit here to start the year. But a good chunk of that appears to be because of U.S. economic data starting 2026. Some of the early December data that we've gotten have been a touch better than expected. Some of the survey data, the ISM data, for example, services number was pretty good to start the year. Now, we can't say with a lot of confidence where the data is at the moment because we're recording on Thursday. By the time you hear this, you'll have seen non-farm payrolls and may have a much better view of the most important piece of growth data in the U.S. But as I look at the way the dollar has responded and the way that global currencies, especially in some emerging markets, have responded here, similarly with industrial metals and some other risk proxies, you get the sense that the way that sort of the dollar's baseline, the rules of thumb around how the dollar does and should trade through changes and shifts in geopolitical conditions might be different here. And I do think that reflects a broader shift in the dollar's role over the longer term as, unquestioned global reserve currency, unquestioned safe haven.
Yeah, all very clear. Like you say, it's certainly been a interesting start of the year. And so in terms of the dollar outlook for maybe looking a little bit further into the future and the major drivers you expect for this year, how are you thinking about that at this point?
So a couple things really come to mind. I mentioned the first one, which is non-farm payroll. As I mentioned, when you're listening to this, you'll know it. We don't know it yet. But the data coming up released in the month of January for December is going to be a lot cleaner than the data we got in November and December because of the timing of the reopening of the government from the shutdown. The Fed warned us at the December meeting, basically said, we are not going to put too many eggs in one basket as regards the economic data released at that time because of the concerns around collection of data, the difficulty around the shutdown, coming out of the shutdown, some of the differentiating assumptions that BLS and BEA and other data producers have to use because of lost data from the shutdown period. So the data we're going to get this month in January for December is arguably the first clean readings we've had on the US on some of these major indicators in quite some time. And so these data, I think, are going to be coming under much more scrutiny, both from the Federal Reserve, from officials, and also from markets. Certainly non-farm payrolls ahead, but also we have the CPI coming up. If you recall, the number we got in December was noticeably weak on core CPI. And I think there's been some general question over whether or not issues around data collection, issues around sampling, issues around timing of data collection may have played a role in some of that weakness in core inflation. Just as one example, because the timing of the collection period, the reference period for that CPI was pushed a little bit later in the month, it's possible that some of the price comparisons were more likely to pick up Black Friday and pre-holiday discounting than in previous years. So just one example of how collection and data related issues due to the government shutdown are feeding into these numbers might mean that these numbers coming up give you arguably a clearer picture of where we are in the US. For the Fed, I think it's still a high bar for the Fed to cut the policy rate in January at their meeting later this month. I think it would take meaningful downside in both growth and inflation numbers to pull them off the sidelines after the signal they gave us in December, which is basically, we think we are in a good position for now, and they need to be persuaded by the data otherwise. But of course, that's what current leadership is saying. We're also expecting at some point soon President Trump to announce his nominee for the next Federal Reserve president. Now, it's a close race in, say, betting markets and certainly among market participants, whether Kevin Hassett, a close trusted advisor, or Kevin Warsh, who's also in Trump's camp as an advisor, though not currently in the administration. Those two are considered the favorites here. But one of the things certainly we are thinking, and we think market participants are also seeing as a potential risk to the dollar down the road, is that under new leadership, the Federal Reserve resumes easing at pace, because most of the individuals in Trump's circle that he's considering for the Federal Reserve are pushing very hard to get interest rates back to a more neutral level, say to around 3% as maybe a guide stone to where they generally believe the policy rate should be at the moment. And so Trump making an announcement on the next Federal Reserve chair could maybe crystallize some of those risks, those potential downside risks to the dollar. So we're still tracking negative for the dollar. We think a combination of still middling labor market, the potential for additional easing down the road, while most other central banks look like they're at their pause point in the G10, broadly speaking. And also some of these fiscal risks and Fed risks also playing into that as well. So I think we've covered a lot of ground here today. Paul, thanks very much for joining. I think we'll stop it there. To our listeners, thanks so much for joining, and Happy New Year to all of you. I hope you enjoyed the holiday period, and I wish you all a happy and healthy 2026. If you enjoyed the podcast today, please consider giving it a like and also subscribing to the channel so that you can get our latest content the moment it's released. Thank you so much.